When it comes to investing, my goal is to buy high quality assets at great valuations. That doesn't go to say that I don't sell anything, because I do plenty of that, and I let valuations tell me when to do that, or if a thesis breaks down for the company. However, there are certain stocks out there that perform year in and year out. These are companies that have the ability to be foundational positions within your portfolio. And in today's video, we're going to take a look at 4 forever dividend stocks for your portfolio. These are 4 companies that provide consistent results, high quality dividends with strong free cash flows. So before we unveil these 4 stocks, do me a huge favor, click that like button down below to show your appreciation, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy completely free. All right, let's jump back into our video taking a look at 4 forever dividend stocks. Beginning with dividend stock number 1, which is going to be ABBV, stock ticker ABBV. And when it comes to ABBV, it is one of my longest held positions within my portfolio, as I have owned it shortly after it was spun off from Abbott Labs. And now we fast forward, comparing both of these companies together, ABBV has far exceeded Abbott in terms of value. The company currently has a market cap of $342 billion, and over the past 12 months, shares of ABBV have climbed nearly 20%. However, year to date, they're up 9%, so still outperforming the market. ABBV is what I like to refer to as an investor's trifecta. In fact, you could say that about a lot of the stocks on this list here today. They provide share price appreciation. If you don't even take the dividend into equation, this is a company whose share price can be solid for you. But then when we add the dividend into it, they provide a solid dividend yield. And on top of that, strong dividend growth, checking off all 3 boxes. For companies that pay dividends, they have to have strong free cash flows. And last year alone, the company generated free cash flow of $17.8 billion. And they generated that with a free cash flow margin of 31.7%. I love to see free cash flow margins in excess of 20%. With ABBV, it's above 30%. And all of this leads to a solid dividend, which currently yields 3.4%. They have a 5-year dividend growth rate at 7.2%, something that I expect to get back above 10% in the coming years. And they have raised their dividend for 11 consecutive years and counting. ABBV and its management team has ran the business fantastically. We have seen efficiencies, and we have seen the growing pipeline come to fruition. Gone are the days of 70% reliability on one drug, which was Humira. Now the company is even stronger and much more diversified. From a valuation perspective, analysts are expecting 2025 EPS of $12.23 per share, which equates to a forward PE multiple of 15.9 times, well above the company's 5-year average of 11.3 times. So as I've discussed before, when it comes to ABBV, it's taking a similar approach that both Merck and Amgen took, where the multiple is low because they had one drug really, but now they have proven themselves with both Skyrizi, Imbruvica, as well as Rinvoq, and hence, which is why investors are paying a higher multiple, and we are seeing that multiple expansion, much closer now to the 5-year average of both Merck and Amgen. Analysts rate the stock a strong buy with an average 12-month price target of $219 per share, implying nearly 15% upside from current levels. ABBV is a great stock to look at for healthcare exposure. And that leads us to dividend stock number 2, which is going to be Broadcom, stock ticker AVGO. We just finished talking about a company that has evolved over the years in ABBV. Broadcom is no different. They were early on in the AI ability, and that is paying huge dividends. This is a company that 10 years ago had top-line revenue of $6.8 billion. Today, over the trailing 12 months, that number is now in excess of $54 billion. The company currently has a market cap of $928 billion. Over the past 12 months, shares are up an impressive 59%. However, year to date, they've taken a bit of a breather as shares are down 15%. 2025 has been less than stellar for the likes of Broadcom, but really any company that has been connected to AI has seen some troubles here in 2025, as that AI bubble has popped here in the near term. However, I still am a big believer in AI because this is a very close race between the US and China, and it's not something that US companies are going to give up on quite easily. This is a company that for years has been a dividend darling. From 2018 to 2022, this was a company that had a dividend yield hovering around or above a 4% yield. On top of that, they had a near 5-year dividend growth rate that hovered around 20%. A high yield with strong 20% dividend growth rate is not something you see all that often. From that 2018 period until now, shares of Broadcom have returned a total of 830%, including dividends. Much of that has to do with the company's ability to generate higher and higher amounts of free cash flow, which you can see is like a staircase higher. Strong free cash flows has led to a strong dividend. And speaking of that dividend, they currently yield 1.2%, so the yield has come down as the share price has skyrocketed. But over the past 5 years, that dividend growth rate still is quite healthy at a 14% average annual clip. And the company has raised their dividend for 14 consecutive years. From a valuation perspective, analysts are looking for the company to generate 2025 EPS of $6.63 per share, which equates to a forward PE multiple of 29 times flat. This is above their 5-year average of 21 times. So again, just like we talked about with ABBV, Broadcom is a company that is evolving, faster revenue growth, more efficient, higher margins, and hence investors are willing to pay higher multiples. This is a company that is very different than they were 5 years ago. Analysts rate the stock a strong buy with an average 12-month price target of $248 per share, implying an impressive 25% upside from current levels. And that leads us to dividend stock number 3, which is going to be S&P Global, stock ticker SPGI. When it comes to S&P Global, they have been a dividend staple, not so much because of their yield, but because of their consistency. This is a company that has consistent results and a consistently growing dividend. S&P Global is a giant in the financial space, providing credit rating data, which is important for investors and creditors alike. This part of the financial sector has a few players with a high barrier of entry. The company currently has a market cap of $157 billion, and over the past 12 months, shares are up 20%, and year to date, they're exactly even. This is a well-established company with a rich history, one that's going to be able to provide results whether we enter a recession or not. And on top of that, a lot of things that investors have been worried about has been the talk of tariffs. When it comes to S&P Global, it doesn't really impact their business all that much. For S&P Global, the company continues to turn higher and higher free cash flow. And in 2024, free cash flow exploded in a good way, up more than 300% over the past 12 months, as the company generated free cash flow of $5.3 billion, a record for the company. And management is operating at an efficient rate with a free cash flow margin of 38.3%. Again, all of this leading to help pay a growing dividend. Again, the dividend yield isn't all that big, slightly below 1%, but they have a 5-year dividend growth rate of 10%, making them a dividend growth stock. And they've been growing that dividend for 51 consecutive years, making them a dividend king. When it comes to the Dividend Kings list, there's only roughly 54 companies on that list. So to make that is a testament to the quality and the consistency of the company. But many companies that you find on that list, they're not able to generate huge amounts of free cash flow to pay that high of growing dividends. SPGI is able to do that, which makes this company have staying power. In terms of valuation, the company is expected to generate EPS of $16.92 this year, which equates to a forward PE multiple of 29.5 times, pretty much exactly in line with their 5-year average of 29.4 times. Looking at it a different way, from EV to EBITDA, that currently sits at a 24.1 times multiple, slightly below the company's 5-year average of 25.1 times. So looking there from two different angles, the stock looks pretty much fairly valued. And this isn't a name that you get huge discounts on all that much. So if you have this on your watch list and you see it trading at a sizable discount, this is a stock that you definitely want to jump in on. In terms of analysts, they rate the stock a strong buy with an average 12-month price target of $5.85 per share, implying more than 15% upside from current levels. And that leads us to dividend stock number 4, which is going to be Prologis, stock ticker PLD. How about we mix things up a little bit here and include a REIT? And if you've been following me for any amount of time, you know that two of my favorite REITs to own are both Vici and Prologis. Both of these stocks could have been on this list of dividend favorites. In terms of REITs in general, Prologis is one of the largest in terms of market cap, trailing only the likes of American Tower and Welltower. I guess you have to have the name Tower in order to be in the top 2. However, when it comes to Prologis, they are an industrial and warehouse REIT, also entering into the data center space. So there's a lot of upside with both AI and e-commerce. Prologis currently has a market cap of $96 billion, and over the past 12 months, shares are up 1%. Year to date, not much change, just down 2%. Prologis is a global company, having properties on 4 continents. They have over $200 billion in assets under management, with a strong credit rating to go with it. Looking here at this chart, you can see the company's property types, as well as their largest customers, or tenants, I should say, which include the likes of Amazon and Home Depot at the top. But let me draw your attention to the lower type of building exposure, where they have data centers. With AI exploding in cloud computing and so on, the need for data centers is evident, and it's an area that Prologis intends to grow over the years. It's still a small piece of the pie, but a growing piece. When it comes to REITs and dividends, because of the structure of REITs, they are required to pay out 90% of their taxable income back to shareholders in the form of dividends. This doesn't leave a lot of extra cash for these companies to increase their dividend at a fast clip, which is why you don't see many dividend, or I should say REITs, on the dividend aristocrat list. There's actually less than 5. However, Prologis bucks that trend, as they have not only a high yield, but a fast-growing dividend at that. Looking here, you can see that the dividend yield is near 4%, and they have an impressive 5-year dividend growth rate of 12%, and management has been growing the dividend for 11 consecutive years. The combination of a 4% dividend yield and strong dividend growth just shows how intriguing Prologis is. From a valuation perspective, analysts are looking for the company to generate AFFO of $4.46 per share this year, which equates to a forward price to AFFO of 23.1 times, well below the company's 5-year average of 26.9 times. And I continue to say that PLD under $100 per share is the area I am aiming to add to my position. In terms of analysts, they rate the stock a moderate buy with an average 12-month price target of $120 per share, implying more than 15% upside from current levels. So there we just looked at 4 high-quality companies, ones that I consider forever dividend companies. Why? Because they have shown their ability to have consistent results, consistently growing free cash flows, and the ability to adapt with the evolving economy. We looked at a healthcare company, a technology company, a financial company, and a REIT right there. So there's something for everyone to find here. But down in the comment section, you let me know which of these 4 stocks would you consider to be a forever dividend stock. And if you haven't done so, show your appreciation by simply clicking that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.